My name is Aureo Pinto. I am an accountant, a registered financial consultant, and an enrolled agent. So I went through the presentations that we had during the year. Not everybody participated, not everybody was part of it. So I'm kind of doing a summary here, and then that'll kind of give us a good wrap up and a good jumping off platform for planning for next year. And I'm going to make it interactive as I always do. So any questions, please ask them. At the end of the presentation, I have a Q&A with questions that I usually get asked by clients and friends, and I'm going to pop those up with answers. But if anything in addition to that comes up, please feel free to jump in. So as part of our year-end review, what we started early in the year was with a vision board. And that's something that we're going to we have to kind of talk about that so that we can do that next month and kind of schedule that as well. It's good to do it toward the end of the year, beginning of the next year, and it kind of gives you a visual of what you want to do. So as part of your vision board, there's different goals and different things that you want to do. So I'll go through that briefly. We're going to be covering budgeting, emergency funds, your basic financial plan, the different components in a financial plan, and then the review of the financial plan, because that's an ongoing process. You started at a certain point in the year, and you need to, and it's a working document. You need to go over it several times during the year when things change, or when you just want to change whatever it is that your plan was initially. A lot of things happen during the year that make you change directions. I'm going to take each one of these individually. The purpose of a vision board is basically to help you set your goals. And there's different kind of goals. You can have short-term goals, long-term goals. Usually short terms are like 3 months, maybe 6 months. Long-term goals are those between 6 months, but they're usually a year and over. So anything over a year is usually a long-term goal. And those can include personal goals, which would be saving for a car or a house, or a vacation that you really want to go for a whirlwind vacation. It can also be savings for retirement. When do you want to retire? What age would you like to retire? Where would you like to retire? You want to move out of the state, go to another location. Um, Also, personal financial goals would include investing, investing in your own accounts for retirement, for your long-term use, or investing in properties or in a business. All of those are financial goals, but you also have to keep it fun. So you should have enrichment goals. So I call the enrichment goals, vacations or travel, or taking a class to cover a hobby that you like, that you want to learn more about. Or an enrichment goal would be just getting better at your hobby. Do you do photography, arts, or crafts, and do you want to get better at them or do more of them? So those are enrichment goals. You can set up a goal saying, I want to take a class in a certain type of craft or painting that I haven't done before, but it's interesting. So goals aren't all money sets. There are also enrichment goals. And then we track them. You have to reassess your goals as you're going along. Things change. Where are you with those goals? Have you met the goals? Are there goals that you want to kind of drop off because halfway there you're like, you know what? It's like that's really not something that I'm interested now. Maybe I can do that at another time. And you don't even push it out to like a long-term goal. You just kind of like take it off your vision board and you're like, I'll set that aside for when I'm ready to put it back on. And that's fine. So where are you with your goals? Did your goals change in any way? Are you going to extend a short-term goal into a long-term goal? Was there something that you started off as a long-term goal that you want to do it quicker? So you kind of push it in to make it a short-term goal. Do you want to do something different or something else? So it's good to track your goals. It kind of keeps you, it's like your little roadmap of what you want to do financially, personally, short term and long term, and it's a living document, so it always changes. It's your wants change, your what you want to do, what you want to accomplish. So, and that is fine, but it's nice to kind of have it, and we do a visual vision board with pictures. You can either draw them, or we do cutouts from magazines, or different pictures that you might have. You probably took a picture when you were on a vacation of a particular location that you like. You might add that back to your vision board to go again, or to eventually have, like, if it was a house, eventually have a house like that. So it's all fun. It's just to get the juices flowing, and get you kind of focused in what you would like to do. Okay. So the second bullet on that first slide was budgeting. So budgeting, there's different steps to take, but the basic one is to look at your expenses. You set up a budget, you look at your expenses. Don't overcomplicate it when you're starting off. You can just take the expenses for 1 week. Look at what you spent in 1 week, kind of calculate what your income was for that 1 week, and look at what your expenses look like. And then you can expand it to maybe a monthly basis. But initially, just look at a week and look at what you can start cutting down. So, one of the budgeting techniques that I recommend people use is called zero-based budgeting. Some budgets will have your income and then your expenses, and then you have an amount left over. A lot of people take that leftover amount, if you have your income being higher than expenses, they'll take that extra amount, they'll spend it. Not everyone will save it. So what I do is I tell everybody you should have a zero-based budget, which means that at the end, you're not going to have anything left over because you have to pay yourself first. So you will become one of the bills that you pay. So just like you have mortgage or rent, utilities, cell phone, car, groceries, you add yourself as a line item, and that's your pay yourself first. So at the end of the month, you're not going to have anything left over because you're going to be included in that budget. And that is the easiest way to start your emergency fund, which we'll talk about later on. So you'll have, let's say, hypothetically, in a particular month, you have $4,000 of income. You have mortgage or rent, you have utilities, groceries, car, transportation, commuting, all of these other expenses. And let's say you have $500 left over. If you add yourself to the budget, I usually tell people that you should be paying yourself about 10% of your income. So if you have, let's say, $4,000 income, your line item as you paying yourself first should be about $400, and that should be worked into your budget. If you can't afford 400, you can put as much as you can into that pay yourself first, because that's how you're going to start your emergency fund, which is very important to have. That way you don't have any money left over, but you have everything covered, including an emergency fund. So you're still socking money away for a rainy day and an emergency. Once you have that going, for a couple of months, you need to monitor your budget. So you track your income, you track your expenses. If you're on a salary basis, your income will probably be fairly steady. If you're switching jobs, your income might either go down temporarily or it might go up. If you have a side gig or a side hustle, your income will also fluctuate. So track your income side, also track your expenses. Have your expenses gone up? What has gone up and why? And how can you control those expenses? How can you lower them? And that takes us into the next box. Look for expenses to cut or reduce. There are certain discretionary expenses that you can work on to reduce them, like cell phone. You can switch to another company that has a better plan. Now they're mostly all the same, but there are some that are much more expensive than the others. And the majority of the bill on a cell phone is probably the cost of the actual phone when you buy it. But the plan itself, they're usually anywhere between 25 to 30, up to like $50 a month for your basic service. But look to see if there's any savings that you can get by changing plans or looking at the type of plan that you have for your cell phone. Also, cable versus streaming. Cable is fairly expensive for a lot of channels that sometimes we don't really look at. Streaming is usually better because it targets more of what you like. A lot of people like Prime Video, and if they already have an Amazon account with Prime, they'll get a lot of the movies that they like there. A lot of people like Netflix or Hulu. So if you know that you're going to get most of the shows and the programming and the movies that you like through one of those, you can then cut down your cable down to the basic plan, just so that you can keep the internet as well if you have a bundled package. And the savings will be an amazing amount because even if you go for like a higher end plan in the streaming, you're still going to have bottom line, you're still going to have a savings between the two once you reduce the cable for that extra amount. Also, car insurance. You can shop around for car insurance. Not all companies charge the same. Some companies have the basic actuarial calculations, which will be the same, but then they have regional costs. Some companies will charge more in New York than in other states, where not all the companies do that. Some will charge more depending on the type of car. So it's good to shop around, and you'll find that there is a major company. Just look at the big players, like Allstate, Geico, State Farm. Between them, you'll find that there is one that's much better than the other as far as the price is concerned. And now that you're doing your budgets or you're reviewing your budget, could be a good time to plan for the holiday spending. If there's extra amounts of, if you have extra savings that you have with that zero-based budget that you did before, even after paying yourself, you can probably pull some of those savings and use it for holidays. And like I said earlier, it's not all just the numbers, it's also, the fun piece of it, the enrichment piece. So it's nice to, you know, um, have a nice holiday and then spend a little bit of money. And then January, then we go back to the zero-based budgeting and tighten the budget a little bit. And this all kind of flows. So the goals will lead you to things that you want to do, which costs money. That leads you into the budgeting where you actually go through your income and expenses. And then the budgeting helps you with the next step, which is the emergency fund. So an emergency fund, it's what is an emergency fund? It's basically a savings account or a savings bucket, if you will, that has about 3 to 6 months of your expenses. And that is always good to have in case you become ill, in case you lose your job or you're switching jobs and you need to cover some expenses for a particular month that you don't have the amount of income that you thought you were going to have. The best way to start saving is from the budgeting slide that we just went through, where you pay yourself first. That payment of paying yourself first is what should go into the emergency fund initially. Once you have your 3 to 6 months of expenses covered, that pay yourself first should continue going on. That doesn't stop. That should continue going on because now you're in that routine. And then that extra amount, you should be putting it into long-term savings. You can buy stocks, put it into bonds, put it into money markets and things like that. And where do you usually put your emergency fund? We recommend the money market account, CD, or high yield savings because those have the higher interest payments. A regular savings account will just pay you 0.5%, maybe 1% if you're lucky, but you need to have a certain minimum. But starting off, if you're just starting with a couple of $100, money market account or high yield savings are usually very good, and they pay very good interest. They have the highest interest payments. Online banks usually have an even higher interest rate because of their overhead being much less than brick and mortar banks. And some of the major credit cards have their own online bank. So, like Discover has an online savings account structure through a bank that they use. I think it's actually Discover Bank. American Express does the same thing. So if you have one of those cards, you can actually open up a savings account with them, and you can transfer from the accounts to pay the credit card. It's much easier to link them together, and their interest payments are much higher and their terms are much better. Their fees are very low, if any. A lot of these don't have any fees as a regular account does. So that those are the best places to put it, and they're still accessible. They're still you can if you link it to another account that you have locally, it's easy for you to pull the money out if you need it in case of an emergency. So it's not like it's tied up. A CD might be tied up if you go for a longer period of time, but if you get like a 3 month CD after you have, let's say 3 or 4 months of savings, I would probably put 1 or 2 months of those into a CD so you get it even a little bit more, but still have enough that you can tap if you need it. And how do you achieve that? By cutting expenses through your budget, like we did earlier, and savings challenges. There's a lot of new techniques of saving money fairly quick, and it's tailored to look like a game, so it makes it easier for people to do it, or makes it a little bit more fun to do it. It's not like you don't feel like you're struggling to do this. So there are several savings challenge. One of them is the 52-week money challenge, which I think is the one of the most popular. A lot of people are doing that. So you basically have 52 weeks of the year, and the week when you start it becomes your week one, and you put $1 away. Second week, you put $2 away. Third week, $3, and you continue. And by the end of the 52 weeks, you have, I believe it's $1,300 saved. 1,378 to be exact safe, because the number of the week is the amount of money that you put in. So when you're like in week 45, you're putting $45 a week away. And then 50, week 52, you're putting the $52. And at that point, you have the 1,378. And that's one of the easier ones. It doesn't require a lot of money up front. There's a second one, which is a little bit more detailed, and that's the 100 envelope challenge. So you take 100 envelopes and you name them 1 to 100, and you put the dollar amount of that envelope into the envelope. And that one's a little bit trickier. Like some people do the envelopes on a daily basis, which is fairly aggressive. Some people do it on a weekly basis, which would take you 2 years to do because you're looking at 100 envelopes. So it'll take you a little bit short of 2 years. And some people just do it when they have that amount of money available. So that can take anywhere from a year to 3 years, maybe. But by completing the 100 envelopes with the dollar amount of the envelope going in, you wind up with about $5,000 saved once you have filled in all 100 envelopes. So it becomes tough when you're like in envelope 90, where you have to put $90 in, or your last envelope of 100, where you have to put the $100 in. So that's why it's kind of aggressive if you do it on a daily basis and sometimes even on a weekly basis. But I think the weekly basis is pretty good. So a little bit short of 2 years, you'll have about $5,000 saved. And then there's the third one, which some people do it and they find it a little bit easier to do, and it's the no spend, the no spend money challenge. So you pick a week, and you decide to not spend anything that week that was not budgeted for. So no discretionary spending. Like everything else that has to be spent, you can spend it, like the rent or any bills that were planned for that week. But anything discretionary for that one week, you do not spend it. If you usually go for like breakfast at Dunkin' or Starbucks, or like lunch, or you eat out like one day a week or twice a week, when you select that one week, none of that takes place. Nothing other than your necessary expenses, your essential expenses will be spent. And some people say that at the end of the week, they wind up saving, anywhere from like $40 if they're just picking up breakfast here and there, to at least 100 if they actually go out and spend for dinner or do takeout. So that's the other way of doing it, the no spend money challenge. You pick a week and you decide not to spend anything out of pocket other than what's really necessary. And that savings that will then go into your emergency fund. So there are fun ways of saving, where that's why they call it kind of like a challenge, because people will say, okay, so I'll see what I can do. And some people combine some of them. Like some people will do the non-spend challenge. So the money that they save and they don't spend, they'll put it into the envelope, and they'll do the envelope together with that. Um, so it's it's kind of fun, different ways of doing it. So you don't feel like you're sacrificing. You're kind of telling yourself, okay, so I won't eat out this week. So that extra $20, I'll put it aside somewhere and I'll put it into an envelope. Or if that's like your first week, then you can do envelopes one, two, three, four, and five, and that'll be your $20 spent or something like that. So that's another way of doing it. So the fourth bullet that we were looking at, or the fourth block, was the financial plan. That's one thing that we've been covering this past year in different bits and pieces. So there was one that we did just retirement, one we did just tax planning. So on this one, I'm just going to summarize the whole thing. So a financial plan is a five-spoke plan. It includes insurance planning, retirement planning, tax planning, investment planning, and estate planning. If you go to a financial planner, those are the five things that we look at. Those are the five things that we help clients put together because all of them are interrelated and each one of them impacts or benefits the other if it's done correctly. So for insurance planning, usually what we say is that you should have life insurance to cover um, your debt, to cover your last expenses, your final expenses, and to support your family for a period of time since they're losing not only you as a person, but also the income that you were bringing in or the financial support that you were bringing into the household. We usually, depending on the income and depending on the person's age, we usually recommend term life insurance. Term life is the cheapest type of life insurance as compared to variable life or whole life. And that difference in price, we usually tell people buy term, which is less, and invest the difference. So if you were to get a quote for a whole life policy, let's say you're 30 years old, let's say male, in good health, you will probably get a quote from a whole life policy of about $200 to $300. That same policy under a term life insurance for, let's say, 20 years or even 30 years might cost you less than $100. So we would say you're looking at, let's say, $200 as compared to $100. That extra $100 that you're saving by buying term life, you should be investing it. So invest that difference. And that then goes into the next pieces of the financial plan, which means you can invest it into putting more money into retirement or actually into putting it into an investment plan, which is the fourth box on this slide. So that's the insurance piece. Retirement planning, we look at a person's age, we look at a person's risk tolerance, and we look at a person's goal of when do they want to retire. Some people want to retire at 55. Depending on their career, they're able to retire at 55. Some want to retire at 60, some at 65, and anywhere in between. So we look at the age that the person wants to retire. We look at how much they have invested in their retirement plan so far, how they have it invested, and we come up with changes or suggestions. So retirement planning would include an IRA where you can direct your own money. You can put money aside into an IRA, a Roth IRA. If you go doing it through your employer, a lot of employers do not have defined benefit plans like they used to, which means that you would retire with a real pension. They've gone away from defined benefit and they're now just offering defined contributions, which means that you need to put money into like a 401k and you need to basically take the brunt of your retirement planning. In that case, then you take advantage if they match your 401k. So if you're able to put away a certain percentage of your salary into a 401k and they match it, we tell clients to maximize on the amount that you can put in so that you get the maximum match. Once they match it, you're getting 100% on your money. And then you put it into the right investments based on how long you plan to work for, and the money will continue to grow at a very good rate because instead of you putting, let's say you're able to put $100 per paycheck and they match 100%, you have $200 going in. So you're doubling what's going in. So that's a very good thing. And that's a very intensive plan because the financial planner has to look at all of your retirement documents. What kind of retirement plans do you have at work, and what do you have on your own outside through like an IRA or a Roth? Then you have tax planning, and tax planning is probably like the umbrella of everything because each of these other four things have a tax impact. We look at the tax planning aspect of it. Capital gains, based on your investments, do you have capital gains that you're paying excessive taxes on? How can we prepare a tax plan to minimize your taxes as much as we can? We look at capital gains and how to reduce those. We look at credits that you can be eligible for based on age, based on investments, energy credits, credits for dependents, for children. We look at those. We look at your deduction. What's tax deductible? How much can you deduct of each category? And there is a piece of it, a piece of tax planning, which in the next couple of years is going to change tremendously. In 2017, there was the Tax Cuts on and Jobs Act of 2017, the TCJA. What that tax law change did was it reduced tax brackets. It did away with itemized deductions, but it gave a higher standard deduction on the tax returns. And it added a few other rate changes that people found to be favorable for them. And it was for some, but it was actually harmful for others because it limited the what we call the SALT deduction, which is the state and local taxes. So you can only deduct up to $10,000 of any state tax that you're paying, and that included real estate taxes as well. So by being capped at 10,000, a lot of people lost a big deduction because between their state tax, if they lived in New York City or in Yonkers, they were paying local tax, and then the real estate taxes was much higher than 10. So they were leaving a lot of money on the table. So though that particular law, tax law change of 2017 is going to sunset in 2025. Once it sunsets, it will increase the tax rates for everyone. So everyone will be paying about 1 to 3% more in the taxes, but it'll also bring back a lot of the itemized deductions that were lost. So for some people, it's going to be a break even. For some people, they're going to be paying a little bit more tax, and for some, they're going to be paying less tax. It's very likely that Congress will not let it sunset, but with the change now in the political parties and who's going to be now running Congress and Senate, there might be a change where it'll either sunset or it won't, or they'll sunset certain pieces of it in order to keep some type of a tax incentive available. Accountants right now, tax accountants, tax consultants, and financial planners are kind of like looking at who is now controlling the tax aspect, the revenue side of the House and the Senate. And based on their history, we're able to kind of figure out which way we're going to go, whether it's going to be stay as it is, so we can start continuing the tax planning, using the same laws that we have in effect, or kind of change our strategy if it does sunset in total, or at least a portion of it. So then we can kind of help the financial plans to stay more tax stable. The next piece is investment planning. So investment planning is basically the money that you're investing after taxes. Retirement planning is before tax, investment planning is after tax. So whatever you have left over, once you have your emergency fund fully funded, you continue to budget, you continue to save money, but that extra money above and beyond your emergency fund should be going into your investment planning bucket. And that's where we then start looking at where you should be investing. Should you be in stocks, bonds? We look at how much risk you're willing to take. How do you want to invest in for how long? Do you want to have an investment portfolio for the long term that you are not going to touch until after you retire? And if you have more than 20 years, then we'll we recommend stocks. And then we look at what kind of stocks. Do you go for blue chip stocks? Do you go for tech stocks? Tech stocks right now a little bit tricky, but over the long run, most of them have stayed higher than they were, so they've been doing well. We look at stocks, we look at bonds. Do you want to be a little bit on the safer side? So if you go for bonds, do we go for corporate bonds or do we go for government bonds? So all of this gets taken into account. And we also then look at the impact that the investment planning is going to have on your tax and vice versa. So if we go into stocks and there's one stock that has a pretty good run and you decide to sell, or your financial planner suggests, you know what, it's like that company probably hit the max that is gonna be at, and it's probably a good time to now sell and roll that money over into a different investment. That sell will lead to a capital gain. So now we have to look at, okay, so the capital gains tax, is it going to be based on the new the current tax law that we have, or if it sunsets or it changes, what's going to happen to the capital gains tax? Will the capital gains tax go up or down? So we will look at that and say, if it's going to change and your tax gains, if the capital gains tax is going to increase, you should probably sell now before the law changes so you can get a preferable rate. So we look at that now, especially this year and beginning of next year, we'll start looking at investments for like for all of our clients and looking at what's best for them to do. And then estate planning. Estate planning is very important for everyone. Even if you don't think you have an estate, you should always have a will stating where you're going to, who do you want to take care of, who do you want to appoint to take care of your valuables that you have. You should set up a trust if it's necessary, depending on the type of properties that you have. You should have powers of attorney in place for people to handle your finances if you become incapacitated at some point. You should always look at your beneficiary designations at least once a year. Things change. You have a beneficiary for your life insurance policy, or a beneficiary as part of your retirement plan or your investment plan. If things happen during the year, birth or a death, then look at your beneficiaries and change the beneficiary designations as appropriate. So these five pieces are an integral part of a financial plan, and everyone should have some type of a touch point in each of these five with a financial planner or an accountant. And then the last piece of that year in review is like once you have the financial plan, you have to review your financial plan. So just like with your budget, certain things change, or your goals, certain things change. Your financial plan also changes. Once a year, sometimes even twice a year, we will look at, the insurance planning. Do you have enough coverage? Did you get married? Did you buy more property? Do you now have a child that you didn't have when you initially got the policy? So we have to reconsider the insurance planning. For the retirement planning, as you're going along, that you change jobs, did they add another retirement option, or did they take away one of the retirement options? So that changes the retirement piece of your financial plan. The tax planning, like I said earlier, if there's a tax law change, a sunset of an old rule, or a change that changes it, that will change that piece of it. On the investment planning, also based on your age, your goals, and your risk. Let's say at some point you're like, you know what, it's like stock market's going a little bit too crazy. It's either going up too much or it's going down. It fluctuates too much. It's too stressful. So then we move away from stocks and we go into less risky and less vulnerable or volatile investments. So we'll go into bonds. So that's something that conversation should take place once, twice, even three times a year. And the estate planning also, like twice a year, look at your wills. If you have any, they need any changes. If you don't get one started, trust, power of attorney, beneficiary designations, and things like that. So that this is it's a living document as well. Your financial plan is constantly changing, and each of these five things impacts the other. And it all changes based on economy, based on your age, based on your risk tolerance, based on your goals. So always have a conversation with your financial planner or accountant or attorney when it comes to the estate planning on these pieces. All right, so now I have Q&A and a plan for next year. So these are basic questions that I have gotten repeatedly from clients and friends, and I'm gonna pose the question and give a quick answer. And then if there's any other questions that you have in any of these topics or on anything, please bring them up. Because these impact how you're going to plan for next year. Just like I said, your financial plan needs to be reviewed. So as you go through one year and you start the other year, you go through your financial plan at the beginning of the year again and see, where am I this year? What do I want to do this year? So all of this encompasses next year planning as well. So for insurance, I usually get the question, what kind of insurance should I have and for how much? And like I said earlier, term is the best option for the majority of the people. Buy term, invest the difference, and coverage is based on that's a calculation based on the income that you're earning, properties that you have, your expenses, what needs to be covered if your income is no longer coming into the household, and for how long do you want to cover those expenses? That will dictate how much your policy should be for. Under retirement, a lot of the questions that I get is, should I be opening up a regular IRA or a Roth IRA? That depends on your tax status. A regular IRA is usually pre-tax, so it reduces the income that you have left over that will be subject to tax. But the counterpart to that is that when you start drawing that money at retirement, you now need to pay taxes because you didn't pay them in the beginning. Now you have to pay them at the end. A lot of people say, well, I'll be at a lower tax bracket at that point. That was conventional wisdom 20, 30 years ago. Over the last 10, 15 years, um, people in retirement stage are actually paying the same, they're actually in the same bracket that they were prior, for the most part. So don't count on your tax bracket being less because the cost of living has gone so high that you still need to draw almost the same amount of income that you were earning when you were working. So your tax bracket will be the same. Whereas a Roth IRA, you're putting the money into the Roth IRA with after tax money. So once you've paid your taxes and you have money left over, that's going into the IRA. That's growing tax deferred. And once you draw it down at retirement, it's tax free because you already paid the taxes in the beginning on that income and then you invested it into the Roth. So that might be the better option because once you're pulling it out, you're not paying any taxes at that point. The Q&A on the taxes is similar to what I went through before. What's going to happen next year when I come to you to file my tax returns? Will I have to pay? Will I get, the same refund that I used to get? And that's something that most of the accountants right now are looking at, what's being slated to change, what tax brackets will change, and the possibility of those. And we're kind of like reaching out to clients and telling them you probably should make an estimated payment because you probably will be owing, or you probably should be changing your withholdings at work. And so we're kind of like working that out right now, and that's taking place on a real-time basis. Some people ask me, side hustle, should I be doing a side hustle? What's the tax impact on it? What's the benefit? And what are the cons? Now there's so many side hustles you could do. Amazon's, you can do Amazon delivery. They have different levels of Amazon delivery opportunities. There's the Grubhub, the Door Dashes, and things like that. All of those, in all of those instances, you're considered to be self-employed. For the most part, you will not get a W-2, you'll get a 1099, which means that you're responsible for paying your own taxes. So if you are doing one of those side hustles, make sure that you keep track of the expenses that you can write against them. If you're doing any of those delivery services, you're using a car, you're spending gas, tolls, and wear and tear, keep track of those expenses because those can be written off against that income that you're earning in order to reduce your taxable income. And some people they like doing the side hustles, a couple of hours here and there. If you're into that, that's fine. Just speak to your accountant so that you can kind of plan for next year if you plan to do this next year. Or if you're already doing it and you saw that there was a certain impact on your tax return this year, bring it up now in conversation to see how you can address it so that it becomes a little bit less of a tax issue later on. Debt reduction. A lot of people say, how can I like cut down on my debt? I have all these credit card bills, interest rates are crazy. What can I do? So there's different debt reduction strategies through like debt stacking. And the debt stacking is basically you line up all of your credit cards and all of your expenses. Credit cards, mortgages, you kind of put at the bottom because those are very difficult to pay off much quicker. But credit cards, personal loans, and car loans. And if you list them from the highest interest first to the lower interest, and you do what's called an avalanche payment. Avalanche payment means that if you have any extra money, you apply it toward the debt that has the highest interest first. What that does ultimately is that it reduces the amount of interest that you're paying long term because you're paying down the one that's charging you the most. Once you pay off that debt, that amount that you were putting, that extra amount that you were putting toward that debt, you then roll it into the next highest interest debt. And then you continue going through as you complete it. And you can wind up paying them off much quicker and it'll be with less interest payments. That's the avalanche method. There's the snowball method, which a lot of people like because what you do is you're paying off the debt that is smallest first. So you would list all your debt from the smallest amount to the highest amount, regardless of what interest you're paying, and you would pay off the ones with the lowest debt first. That works for people who need to see like um, a quick reward. So if there's one that you owe $500 and you're able to get that one knocked down, you're able to put an extra $100 per month. You get it paid off in 5 months. At 5 months, you're looking at it and you're saying, "Wow, I already got one down. Now I can move on to the next one." So for people who need that quick gratification, the one with the lowest debt first is best because you start knocking them out much quicker as far as the debt is concerned, the actual amount that's owed. And it's the same with the avalanche. Once you finish paying that off, that same amount that you were paying, you roll it into the next highest debt amount that you have, and you continue all the way through until you complete it. Then there's the snowflake method. That one is fairly new, and it's happening a lot now with side hustles. So people who have like extra money from a side hustle, they don't count that as regular income. They'll take that and they consider that to be like a snowflake effect. So that extra money that they really didn't think they were going to earn because they weren't earning it as part of the regular salary. This was like an extra. They use that and then they apply that extra money that they earned to one of the debts. And then you combine it. You can either put it toward the one that has the highest interest or the one that has the lowest amount of debt so that you can start paying them down. So usually those two go hand in hand, like the snowflake, because the snowflake is not using your money that you regularly earn, is usually using money that you've received or gotten that's an extra. So that'll be like a side hustle. It'll be you got a tax refund from filing your taxes. So that extra money you apply toward the debt. So things like that. And that's like the best way to reduce the debt. And while you're doing this, also stop using the credit card so you don't accumulate more. So this goes hand in hand with the budget. Make sure that you're controlling your debt while you're paying your old debt off. One of the biggest questions on the investing side that I've been getting now the last month or so is how will the economy now react based on the election and the politics? So as you've seen over the last couple of weeks, the market has gone up dramatically. Uh, that will come down. That will not continue going up, and it will not stay up. It's uh, it's an artificial inflation based on a particular point in time in our political history that really has no true meaning to the stock market because the stock market is usually driven by the earnings of the company. So if a company has very good earnings, they have a very good market share, they have a very good product, they have a very good consumer backing um, and consumer sentiment, that will drive the stock price of that particular company. And companies in the same industry that have that same benefit and that same outlook, that will drive those prices. Not this crazy jump of 500, 600, 700 points, per day, which will eventually come down because now we're in the third quarter, or fourth quarter. When this fourth quarter ends and companies start doing their year-end financial statements and they come in with their earnings, if their earnings don't support that price that the market has for it, that stock price will come down and eventually everything will settle back down. So that's one of the questions that I've been getting. Should I stay in what I currently have invested, or should I invest in this company that all of a sudden now it's going up? What's going to be the risk? Um, how is it going to change based on the economy? What's going to happen based on the change in the presidential office? Will that change the interest rates? Will that change the economy in general? So those are questions that right now are really coming up. And what I've been telling everyone is stay where you're invested in until the dust settles. You don't want to sell something now, get hit with a capital gain, invested in something that's running up that might already flatten out, and then you wind up with a loss. Whereas if you stay where you are and the dust settles, then we can really decide in the next quarter of next year, should you still be invested in that company or in stocks or in bonds, and what are the other options? So that's something to keep in mind right now. So this last piece, similar to the prior slide with the financial plan, this is an evolving document, living document. These should always be updated. Your wills, power of attorney, proxies, health proxies, things like that. Always check these at least once a year to make sure that they're still accurate. If there's a life-changing event, there's a death, there's a birth, there's a change in health status or a change in a particular investment or job that might impact the will or estate or even a power of attorney. Make sure that you change those timely so that you have the latest documents that you should have. Also look at beneficiaries again in any of your accounts. If you have investment accounts, retirement accounts, uh, savings accounts with beneficiaries, make sure that those beneficiaries are still the beneficiaries that you want, that they're still the ones that should be listed as beneficiaries. And that's my information, and that's it.